Welcome to the John Sanchez Show on News Talk 780 KOH. Pleasure to be with you, and a pleasure to be with one of the Edge team members, Mr. Aaron Clark. How
I'm
are you,
doing
my
good.
friend? Good to
Yeah, I
have
haven't
you.
seen you since the 4th. Since before the 4th.
Exactly. It seems like
I
an
know.
eternity ago. I know Aaron and I were joking before the show. I was like, man, I wish this was like last Thursday where, market was closed tomorrow. We had a 3-day weekend and all that. But
Back to the norm.
Got to grind it out. Back to
Yeah.
the norm. Back to the norm. Exactly. How's the world of real estate treating you, my
Going
friend?
good, man. This is like the 4th of July week is kind of like a slow, relaxed week in our crazy madness of summer. So it was enjoyable.
Yep. Good. Glad to hear it. Yeah. Corey always emphasizes how the real estate market locally peaks around this time of the year. So yeah, it's, you think that's going to happen this year? Or do you think you got too good of
I
momentum?
feel like we've kind of just been where we've been and haven't really moved too much off of that. I mean, little fluctuations. So I don't know that there really is a big peak. It's more like probably a rolling hill, So
Got
I
it.
don't think we'll see a big fall off or anything like that. I think it'll be kind of straightforward
Okay.
until probably the end of summer. The reason we say that is because kids go back to school, and so primarily you don't get a lot of people that are wanting to buy when the kids are back in school. But a lot of that's changed over the past few years too. We're not seeing those impacts like we used to.
See, every time he mentions that, I always bring that point up. It's like, I mean, when you and I were going to school, we didn't have, at least when I went, I'm much older than you, but there was no such thing as year-round school. I mean, it was your traditional, you get out in June, you go back at end of August, beginning of September, and, so on and so forth. But, I always wonder that, with year-round school and the crazy schedules and all the different, private schools and so on and so forth that we have here locally, it's completely different this time.
I think COVID really changed that sort of normative way of doing it. Well, I mean, just like work, right? Like, everybody knows somebody now who works from home. And before COVID, it was like, wow, that's seeing Santa Claus.
Yeah.
Like that just doesn't exist. When somebody said I'm a remote worker, you're like, what is that? What is this wizardry that you have?
Right. You're right.
Now somebody says it and they're like, yeah, I tried that. It was cool, but I never worked. So,
Gollies. Yeah, good old times. Yep. That's for sure. All right, my friend. Well, let me tell you what. Welcome everybody. First of all, let me tell you what Aaron and I have lined up for you. We're going to go through the stock market recap. Quite fortunate. Just like I said yesterday, don't get excited when this market sold off yesterday after the president called off the ceasefire and missiles flew, and then they did it again yesterday, right during the show. I was joking yesterday, Aaron. It seems like for the last 2 days, it happens right when the show starts. We get the headlines coming across. Well, missiles are flying again, and so just a strange coincidence. But yeah, woke up this morning. Market's like, yeah, we're not concerned about that. Didn't really have any positive comments other than Trump said this morning, Iran called me and they want to make a deal.
Oh, wow.
And
sorry to be cynical. Wow.
Was that during the, all their radar facilities, on fire and there's 60 boats that were blowing up? It was at that time period they said they wanted to do that. In all seriousness, or actually kind of joking serious, can you imagine if that's true, Aaron? Can you imagine if that's true? And you're sitting there and you're the commander in chief and you just, issued the order to, continue the airstrikes and stuff. And all of a sudden your assistant comes in and says, excuse me, Mr. President. Yeah. I'm busy. I'm watching, what's going on in Iran. And it's the Iranian leaders. They want to talk to you. Hey, Fred, how's it going? Sir, we're a little upset right now that, our radar just got knocked out and so on. So you want to make a deal? You want to talk about this again? You go grab a cup of coffee and let's sit down and have a little video chat. That's why I always visualize it with stuff like that. So again, don't know, but the street, all that matters, the street believed that Iran called the president and said they want to make a deal, but never heard anything more about it the rest of the day. But the market didn't care. The market rallied. Oil prices fell, and that's all we care about. It's our clients making money, and everybody's happy. So I'll give you all those details here in a moment. But let's get to the real estate topic that we're going to be discussing. We've titled today's show, Should You Sell Your Rental Property or Should You Keep It? So here's a scenario I want you to think about. This is kind of our imaginary client. Your rental property you just found out, you looked at Zillow, you talked to a real estate professional. Your real estate property, your investment property has appreciated dramatically. But the downside is your tenant just moved out. So the first question that goes through your mind is, well, Should I sell it? Should I do a 1031 tax deferred exchange? Should I do a what's called a Delaware Statutory Trust Exchange, or DST? Or should I go out there, try to get a new tenant, start collecting rents again, and come back and revisit this at a later time? Aaron, I bet you wish you had a dime or a dollar for every time one of your clients have called you and said that exact scenario,
Oh
right?
yeah, a dime would be
Yep.
fantastic.
Yep.
A dollar would be
A dime
amazing.
would be fantastic. That's right. That's right. Well, I had this discussion with a client this morning, and that's what prompted me to be thinking about this. So today, what Aaron and I are going to do is we're going to discuss one of the biggest financial decisions you ever make as a rental property owner, as a landlord. If you do it wrong, very costly tax mistakes can hit you. So we're going to go over some things to make sure that you don't make those tax mistakes. Also, look at all the pros and cons, and really, I want to get Aaron's advice on what does he actually tell his clients when that phone call comes. I'll share what I tell my clients, but he's the real estate professional. And my conversation this morning, Aaron, with my client he was pretty adamant. He just had a tenant, like I said, left, and that was the reason for our phone call this morning. And within 10 minutes of the phone call, I gave him my numbers and my analysis and stuff. He's like, "Yeah, you know what? I'm going to go get a new tenant." It was literally a 10-minute conversation. And I think that's what happens a lot is when you own your own property, if you're trying to figure these things out on your own, it's really an emotional decision. It's almost like, geez, do I buy a stock? Do I sell a stock? Right? Because you're looking at it and you're going, wow, I bought it for, 200,000. It's worth 600,000 now. Wow, I could just make 400,000. Oh, shoot. I've got these things called capital gains tax. And then people are still very confused about how the rules and how things work when it comes to doing a 1031 tax deferred exchange, or even something like the DST that we handle for our clients. And so they look at that and the brain starts spinning, right? You're like, oh, what direction I go? I'll come back and I'll think about it later. But in the meantime, what usually prompts that, of course, is you lose a tenant, whether tenant dies, tenant moves out, whatever the case is. In this case, the tenant did pass away. And he had, I remember talking to him years ago about this. He was it was out of the kindness of his heart. It was a very, very below market rents that he was collecting. But again, I won't go into the reasons why he was doing that, but he had rational reasons. But now, you look at it and talking substantial increase in rents that he's able to get now, right? I mean, significant. And so, we ran the numbers and looked at the, cash on cash return and alternative things that, if he did sell it and lost money to taxes, et cetera, what could he do with that money, and so on and so forth. And like I said, it was about a 10-minute conversation, and boom, we made the decision to stick it out and get some new tenants in there, and boom, here we go.
Yeah, I find a lot of people too in that moment when they are getting super overwhelmed with the situation. I mean, you have the fear of getting into the what ifs and whatnots and whatever, but then people will
Sure.
also get into the fear of just, I'm going to make the wrong decision and not find out till later. Like, my whole life I was trying to accumulate a rental property, and if I sell it now, what will people think? And I was trying to do that. Is this dumb?
Yeah.
So it just gets so overwhelming, and that's where you have to
It
run the
does.
numbers, because then you're not making a mistake, because the numbers will not lie. That you'll be able to evaluate the numbers and
Right.
realize,
That's it.
because a lot of people, many people I talk to, they'll think, I've got $400,000 in equity. I'm just going to stick that $400,000 in my pocket. And I go, the first word we
Yep.
use is the dirty word that starts with a T, called taxes. And then they look at it and go, okay, well, it can't be that much. What are we talking, like 10 grand, 15 grand? I mean, out of 400, that's
Yeah,
nothing.
right.
But then when you start crunching the numbers
Right.
and you realize it could be up to 50% of that $400,000, depending on how long
Yes,
you've
that's
owned it,
right.
how much it's appreciated, how much
If you're
depreciation
in
you've
a
taken.
state like California, where
Yes.
people always, you know
Yes.
this, Aaron, people forget California has their own
Mm-hmm.
capital gains tax, as well as a lot of states. We don't obviously here in Nevada, but a lot of states
Yeah.
do. And yeah, you're right. But I'll let the cat out of the bag. One thing I always like to bring to everybody's attention, that I still, even when I tell clients, if they're thinking about selling, go to talk to your tax professional.
100%.
Make sure that they understand what's going on. And they come back and I said, by the way, did your accountant talk to you about depreciation recapture tax? Like,
No one
no,
ever
what
knows
is
what that
that?
is. Yeah.
See, okay, good. So you're in the same boat as me.
Yeah.
Yeah. And until we bring it to our clients' attention, they're like, and folks, I'll just tell you right now, it's a nasty tax. In some cases, it can be higher than your capital gains
Yes.
tax. and
Can
people don't
wash out
realize it
all
because
the
it's not.
equity.
Absolutely, it can. Absolutely, it can. Does California, Aaron, still have that rule where it escrow closing they withhold, and I can't remember what it was. It was like 5% or something, regardless of whatever. They're going to withhold 5%. In their mind is for the California capital gains tax. Does that
I
still go on?
believe
Do you
so. Now
know?
I'm
No,
not
you don't do a
licensed
lot of
in
business in
California, so I don't
California.
know if it's changed, but I believe they
Yeah.
still hold. They trust me, California's going to
Yeah.
get their
I
money.
remember that. Yeah, yeah. I remember that was always a big surprise.
Yeah,
I had one client years ago, and they thought they were going to walk away with a bunch of money, and they go to closing, and then they're waiting for the wire from escrow, and here the wire comes,
and then they
and
hold
they
it.
called me. I'm
Yeah.
like, oh my god, I just lost. I forget the dollar amount, but it was substantial, and yeah, it's like California's like, you know what? It's just it's a goodwill
Yeah,
deposit. That's the way
it's
they kind
it's
of
a
look at
ransom
it.
so you don't
We just want
run.
to make sure it's a ransom. That's right. That's right. That's right. So yeah, so it's going to be a really fun topic to discuss, and we'll share with all of you some of our war stories, which is really the best way to understand things. So let's get the stock market side going, Aaron, and get that out of the way. So, like I said, it was a day that we had pretty good strength right from the opening bell. Even in the pre-market session, things were going pretty well. Dow kind of struggled throughout the day. Didn't really get all that excited about, again, the president indicating that Iran wants to make a deal. But we had, once again, thank goodness for these things called semiconductors. We love them one day, we hate them the next day, and today was one of those days. After yesterday, they were not loved, and a couple times this week they were not loved, but boy, they loved them today and drove the Nasdaq to a nice level. Gained 336 on the Nasdaq, 1.3%, closed at 26,206. Dow 139 point gain, it's only a 0.25%, 52,487, and the S&P higher by 61 points or 0.81% to close at 7,543. So rotation back into the semiconductor stocks. Again, yesterday was more of a rotation out of semiconductor, back over into consumer cyclical staples, the things that aren't really, quote, really economically sensitive. Pretty good run up in applied material today. So I want to mention this one, up $18.16, about a 3.18% gain of 588.60. The CEO of Applied Material, AMAT, Gary Dickerson's his name. He said that chip makers are preparing for years of expansion. That reinforced the optimism surrounding AI-related capital spending. You had, I'm not sure if you saw that story or not, Aaron, on Meta. They're basically going to be producing their own, AI chips and so on and so forth, which I don't know about
Yeah.
that one. But anyways, that made that stock bounce a little bit. Micron was strong today at $42 and some change. Lam Research, the whole group, AMD, etc. Cruise lines, they rebounded after yesterday's sell-off because, again, today it's safe to go on a cruise line around the world. Norwegian Cruise Lines up almost 7%, 6.98 to be exact, $1.29 gain in 1976. Tesla had a nice rebound, up $12.49 to 406.55. Interesting one on this one, Costco. Again, Aaron, I don't know about you, but I like to look at Costco as almost a barometer of the economy, right? Of consumer spending, more so the higher end of consumers, right? Stock lost $40.16 today, 4.21% loss to close at $912.97. June comp sales came in a little over 8% growth rate, which, trust me, any retailer would give anything to have those numbers, but that was down from over 12% in the month of May. So they punished the stock, said, consumers slowing down, so they punished that. Also in the consumer sector, you had Pepsi today report numbers, very slight earnings beat, but sales in North America were down. They punished that stock down 3.25%, $4.65 loss to 137.86. So, like I said, it was kind of a mixed showing there. The show on Newstalk 780 KOH with Aaron Clark of Edge Realty. Mr. Millard again is still on vacation. Of course, he had the week off. All right, once again, we finished with a gain of 139 on the Dow. The Nasdaq rose 336, S&P up 61. All right, we're going to get right to our real estate topic. Again, should you sell your rental property or should you keep it? Very interesting scenario to be thinking about. Once again, on the commodity side, we lost $1.43 on oil, $72.10 a barrel, up $58.20 on gold, $41.60 an ounce. There's a nice round number for you. And the 10-year Treasury down 3 basis points on the day to a yield close of 4.54. And in the absence of Mr. Millard, according to Mortgage News Daily, 30-year fixed mortgage down 3 basis points to a yield of 6.65%. It's just not budging, Aaron. That mortgage rate is just not. It's like for weeks we have said 6.63, 6.65.
Yeah.
So that's goodness. Yep. Come to the reality. It's just going to hold the steady. All right, let's get to this topic, Aaron. This is fascinating. Once again, our scenario is this: you're a landlord. Things have changed. You realize, hey, you know what, man, I've got some nice equity built up into this thing, and but guess what? Your tenant just moved out. Then you start thinking in your mind, should I sell this? Should I complete a 1031 tax deferred exchange? Delaware statutory trust, which we'll go into in a little bit here. Should I keep collecting rents? Right? What do I do? Well, we're going to lay out some scenarios, right? Every scenario is different. We can't say, oh, yeah, so always want to sell. You always want to, stay there. A lot of different things. And that's what we're going to be talking about, real life examples of that. Because, for many, many of you, a rental property represents, like Aaron said earlier, literally years or decades of hard work, right? You sacrificed, you went over there, you did repairs, you did this. Maybe it's your first one, maybe it's your 10th one, whatever it is. But the bottom line is you've watched it steadily appreciate over time. So you got a little bit of love towards that thing. Then one day again, you get that phone call. Hey, I'm moving out, giving you my 30-day notice. What do you mean? You've been here for 10 years and I gave you below market rents and all that stuff. And like, nope, I'm moving on. I'm buying a house or moving somewhere else, whatever the case may be. And then the light bulb comes on. Should I sell? Should I keep it? Should I exchange it? Which I want to get Aaron's opinion on how many times people come to him and say, hey, should I exchange it? Because what I find is, Aaron, most people don't even know about the tax deferred exchange. So today we're going to walk through exactly how you make those decisions, because guess what? Selling an investment property isn't like selling your primary home. It isn't a simple real estate decision. It's really a financial planning decision, because you do it wrong. And as we were saying at the first segment, you can cost yourself a significant amount of money in capital gains tax and other forms of taxes. So Aaron, when someone calls you and says that scenario, I imagine the first question you ask them is, why are you selling?
Oh yeah.
Take it from
Yeah.
there.
Yeah. Because
What are the common
the
reasons?
common reasons usually are, of course, the tenant has moved out, and so now they're reevaluating
Right.
everything in life, just like we do if you lose a job or something like
Yeah,
that.
that's a good way to put it. They
Yeah.
reevaluate everything. You're right.
And so you have that scenario. A lot of it is people are just tired of being a landlord,
That's what I hear number one with
or
our
maybe they
clients. Yeah.
have four of them and they're just like, they just retired from work and their life focus is changing, and now it's time to cash in and break all the piggy banks open and not do anything anymore. They're getting frustrated because let's say maybe it's a poor quality rental property, so they're having a lot of problems with it, meaning it's really old and it's requiring a lot of repairs. They're having issues because they don't live here, and they're using a property management
Good one.
company, and so they're having issues with the property management company and finding a good one, so it's been frustrating. I mean, a lot of those things are all key factors, and I've had a lot of people where they're undercharging and they haven't raised the rent in 10, 15 years on properties, and they're
Yes.
literally below
Yes.
50% of what the market rent is on the property, and
Yep.
so they just don't see the value at all with the rising cost of everything else.
Yep.
So there's a
That was my
whole
scenario with my
bunch
client.
of different scenarios that people will call to sell for.
Yeah. The ones that I hear is number one, I'm tired.
Yeah.
I don't want to be a landlord anymore. When I ask why, 99% of the time the catalyst is they had a bad tenant, right? I mean, you and I both have had the
Oh yeah.
stories. You know,
Squatters,
did my
non-payment.
annual inspection, squatters. Did my annual inspection. Place was ransacked. They stripped everything out, including copper wire. Many times I've heard that one. And I'd say the second biggest one is, like you just said, is the major repairs. Usually, of course, a roof, which is going to be one of your more expensive things. Like I don't want to spend 20 grand on getting a new roof put on this thing, so I want to get rid of it. So, all right. So you hear the same things that I do. Beautiful. Let's go to question number 2. What will it cost you to sell?
Yeah, so the other part of it is finding out exactly when we decide, why they're selling it, what it's going to cost them to sell, because depending on what they bought it for and what it's worth today, that equitable number and how long they've been depreciating it, was it their primary residence that they converted? How has their CPA been doing their tax structure on that property? Have they been collecting receipts over the years for upgrades, repairs, things like that? All of those things will,
Which would lower their
yeah,
cost
all of
basis
that will
or
determine
increase
what
cost
the
basis.
value of the property is and what they're going to end up paying. And then, of course, like we said earlier, we have the depreciation on the sale of the property. A lot of people, they understand that they've been doing it, they understand why they've been doing it, but they don't understand what that could even total or close to. So they don't even
Right.
consider it. It's like going to
Right.
the dentist and they say, we got to pull one of your teeth, and without taking an x-ray, they just guess on which one it is. Like, that's, yeah,
Good
that's
analogy.
that
Ouch.
is the
Yeah.
reality of it. So I always tell people, I'm like, listen, the first thing you need to do is you need to talk to whoever's been doing your taxes and find out what the cost is going to be on this. Now, we can offset those things and defer those things by doing a 1031 exchange, or doing the
Mhm.
Delaware exchange.
DST.
So all of those things are ways that if we've determined we need to sell the property, we're going to sell the property because maybe it's something that we can't control, that the only way we can control is to sell it and move that money into something else. So we
Hmm.
still want to keep some sort of investment style alive in real estate. Then by doing that, we can do an exchange, and then we don't have to pay any taxes. So all of those are determined by that.
All right. When we come back, we're going to break these down because
Yeah.
these points that Aaron just covered, these are really the gist of today's subject, which is we're going to go deep into capital gains. Make sure you have a thorough understanding of the long term capital gain structure. We're going to go deep into the depreciation recapture and state taxes because man, this is why Aaron is so good. You do this. We do the same thing. You got to talk to the accountant after you talk to the real estate professional, get an idea what this property could sell for. You start doing a pro forma and say, if I sell it for this, here's my taxes and so on and so forth. So there's no guesswork. That's the worst thing. All right, we're just getting started on, again, should I sell my rental property or should I keep it? To the John Sanchez Show on News with Aaron Clark of Edge Realty. Great to be with you this Thursday afternoon. All right, we're going to get back to our topic today, which again, very, very interesting. Should you sell your rental property or should you keep it? And again, the scenario that many of you that are landlords that go through or could go through at some point, you lose your tenant, your eyes are open, you're like, you know what? This is maybe my out, right? I'm tired of being a landlord, or, geez, look at just got an offer from a real estate agent, and they're saying, geez, I could walk away in my house, I could make 500,000 profit on this thing. I've owned it for so long. Well, we want to just tone you down just a little bit, right? We don't want you to get too excited yet. Hopefully that will work out. So what we're trying to do is bring some questions to mind that you need to be thinking about. Again, we started with, why are you selling? Again, I'm tired of being a landlord is what Aaron and I hear the most. I need the cash. There's better opportunities. Maybe I'm not getting the cash flow that I expect. I'm retiring. I just don't want to do this, so on and so forth. Now, here's where we left off before we went to break. What will it cost you to sell? Okay. So, what Aaron and I want to do right now, we're going to get a little technical for you because we were both comparing notes during the break that we're amazed many times, that we have clients of pretty good financial stature and they have very little, if any, understanding of the tax structure and so on and so forth when they go to sell an investment property. Aaron, I don't know about you, but just real quick before we get to the list, I've had clients that think that the $250,000 or $500,000 tax-free exclusion that we enjoy if we are, for our primary residence, applies to a rental property. Have you had that
Yeah,
one?
I have that.
Yep.
And then they miss the term that, they have to live there 2 out of the last 5 years. So they think that if they converted
Yes,
their primary residence 15 years ago, that they never have to pay it. They're exempt from it.
that's
So they
right.
don't understand that
That's right.
either.
Yep, that's a good point. Okay, so let's get down to the tax side of things. And once again, before we get into this, we are not CPAs, we are not attorneys. We do want to emphasize the minute that you are convinced that you are going to sell it, or when you're doing your due diligence, what Aaron and I both recommend, and we tell our clients, you got to go talk to the accountant, and you're going to understand why here in a second before you sign any listing agreement, before you do anything. All right. So, Aaron, let's talk long-term capital gains. You want to tackle that one, or you
Go
want me
for
to
it.
tackle
That's all you. That's your world.
All right. So remember, folks, long-term capital gains applies the same for stock market assets as it does for real estate. Long as you own that property 12 months or more, it's going to be taxed at the long-term capital gains rate. Now, remember, standard answer is, excuse me, is 20%. But it can really, depending upon your income level, it can be up as much as 23.5%, or it can literally be down to zero, right? So your capital gains rate is based upon where you are in the income tax table. So that's one of the first things you will ask, or your accountant should know is, okay, yes, you're in the maximum capital gains bracket, or geez, yeah, I don't have to pay any capital gains tax. You should know those things. But the bottom line is, here's what happens with us a lot, Aaron, is, the client will do as we said, they'll talk to their accountant, they decide they want to sell. And then, which is a very smart move. And I get this sometimes. They'll say, "Okay, hey John, we just sold this rental property and we've got $500,000. I'm going to give it to you and you guys invest it." Like, no, we are not going to do that. At least the full amount, right? So we always say, "What's your tax liability?" Oh, it's $200,000. Great. We're going to take that because it's not due until April of next year. We're going to take that 200,000. We're going to put it in some short-term treasuries, some CDs, something very safe and secure. You do not ever want to take risk on that. The rest of it, okay, are you sure you're never going to go back into real estate? Or they'll do this on their primary home, Aaron. Same scenario, walk away with $500,000. They're like, yep, we're going to, I don't know, take 6 months off. We're just going to rent, or take a couple years off, rent, travel. Okay, are you going to end up using that 500,000 again? You're going to buy another primary home? Oh yeah, eventually. But I want you to invest in the meantime. Nope. Don't do that. You don't want to take risk with those types of funds. Okay. So long-term capital gains, average numbers about 20%. It can be up as high as 23 and a half. It can be as low as 0. That's, again, the question you want to have your accountant answer. Okay, let's talk the unknown, the big phantom expense, Aaron, depreciation
Yeah, keep in
recapture.
mind that, when you have that asset over time, we use depreciation in everything. Even the Washoe County assessor, for example, when they're giving you your annual report of what your home is worth, depending on the age of the home, it'll affect your tax rebate structure of what your home is worth minus whatever the age of the home is. There's a depreciation value. That's why you're not paying taxes on what the actual home value is if you were to sell it. In the same way, if your accountant or CPA or whatever has been filing your taxes on your rental property and taking the depreciation every year for the past 20 years, when you go to sell that property and you make a profit on it, you have to repay that depreciation that you've been taking every year. That's why, again, going back to what we were talking about earlier, in almost all cases, when someone calls me and says, "I want to sell my rental property," usually, and myself and John, we are the first people you should call to get an idea of what it would look
Yes.
like before going to the CPA and saying,
Yes.
"Now that I know what it would look like and what the
Yes.
dollars are, now break it down for me." In that conversation, most of the time, I would say it's better to do the exchange. Almost never is it better to just sell the property, because we can, in essence, do the same exact thing, but never have to pay any of that money back to the IRS. That
Mm-hmm.
Uncle Sam gets nothing, because you're reinvesting it, which is still cash revenue
Mm-hmm.
for taxation. So depreciation
Mm-hmm.
recapture can
Mm-hmm.
cost you. I've seen people where they sit down and they think they're going to get $100,000 at the end of the deal, and we sit down and they owe 20,000 because they took the
That's right.
depreciation for so long and they didn't recapture it. And no matter how
That's right.
many times I say, now that we have the information, talk to your CPA, they go, "No, I'm good. I'm fine." Okay, are you sure? I make money
Yes.
whether we sell it and you pay taxes or you don't pay taxes. So I'm
Right.
helping you by
Right.
saying
Right.
don't sell it until you talk
Yes.
to them.
Yes.
And I've had a few
That's right.
clients that
That's right.
learned very difficult lessons from consequences.
Learn, yeah, as the saying goes, unfortunately, yeah, as the saying goes, they learn the hard way. So I want to go into a little bit more detail, because again, you should know what
Yeah.
depreciation is, right? That's one of the big advantages of owning an investment property. It's again, it's called a phantom expense because it doesn't cost you anything. It's one of the major benefits of owning real estate. Everything other than dirt, basically.
Mm-hmm.
So anything where there's a structure, you can depreciate it. If you own a ranch, you can depreciate your barbed wire fence, your well house, or your well casings. I mean, and then, which Aaron and I will, or we'll do a show at some point called segmentation, right? This is where you really sharpen the pencil, and you don't say, "Oh, it's a investment property." What's investment now? 29 and a half years, I
Yeah.
think, Aaron. You're
Yeah.
somewhere around there. So instead of that, you go, "Oh, no, no, no! I want to segment the copper wire that's in
Yeah. You can go
my
crazy.
building or my house. I want to separate my HVAC, which I think HVACs are at like 7 years or
Yeah.
something, right? So you break it down and really, really accelerate that depreciation. So whole nother subject on that. But the bottom line is, you got to go back, and this is why keeping utmost perfect records is so very important. Where I see people get in trouble also, Aaron, is a lot of times people will switch accountants and they'll lose that ongoing number. That should be a rolling number that you see, kind of like a tax loss that you see on the tax return. So if you're going to switch accountants, make sure you know and you see it clearly how much that accountant has been writing off before you move to the new accountant, to be able to make sure that data transfers over. But the bottom line is, let's say you've owned a property for 10 years, and every year, and it's never the same, it usually drops, but every year you're writing off $10,000 in depreciation, right? That's lowering your taxable income. That's why the IRS says, hey, guess what, Mr. Clark, you're selling this house after 10 years, you've averaged $10,000 a year, so that's $100,000 in depreciation you've taken. Guess what? Now it's time to pay the piper. So we're going to charge you, and it's not a flat 25, it's up to 25 is kind of, the average answer, but up to 25% tax on that. So you think about it, just like Aaron said at the beginning of the show, 25% depreciation recapture tax, 20% long-term capital gains, 40% easy. And again, for our friends over the hill, guess what? You add in, roughly 5% or so on the state side. And I mean, imagine being New York, New Jersey, some of these really, really high tax states. It's even worse there. So just be very cognizant when you are crunching the numbers to make your final decision that you understand what depreciation recapture is. We touched on the state tax. And then, of course, your real estate commissions, right, Aaron? That comes into the
all your
factor
closing
also,
costs,
as far as, all your closing costs, and what you're going to walk away with. So there's a lot of things that you have to know before you make that final decision. All right, when we come back, let's talk about what return are you really currently receiving? Because that's also where this breaks down. People go, oh, geez, I'm only making this. But in reality, you're probably making a lot more. Welcome back to the John Sanchez Show on Newstalk 780 KOH with Mr. Aaron Clark of Edge Realty. Aaron, your
673-6700.
Beautiful. Thank you. All right, Aaron, let's get back to our topic again. This has been fascinating. I think this could have easily turned into a 2-day type of topic because we're really just scratching the surface. We're talking once again about, should you sell your rental property or should you keep it? Once again, now we're to the third question you should be asking yourself. What return are you currently receiving? Aaron, we can get really complicated and get into cap rates and get into this and get into that. Break it down into a simple term for the guy or gal that's out there contemplating to sell.
I mean, the simplest fact is we have to look at what our property is bringing in income-wise compared to what's around it, so that we know exactly if it's set at current market value. That number is going to determine a multitude of things, and I can guarantee you that if you're not raising your rent at least some per year, year over year for the last at least 10 to 15 years, you're under market value. So you have to look at that. And I know it sucks to send it.
And how do you find that out?
Honestly, the best way is to get on Zillow's rental finder and look at what comparable properties are in the area are going for. Take mental note, check back a week later, which ones are gone, which ones aren't. The ones that aren't are overpriced. The ones that are gone are the ones that were underpriced if it was too fast. And the ones that, they're gone in a week or two, then they're probably priced pretty well. It's rental comps, basically. So you want to make sure. And you can get a good idea without even watching anything specific by just seeing what stuff similar to yours is going for. And if you're renting yours for $1,500 and everything's for $2,500 to $2,300, you're way under market value. So it's time to bring it up. Now, when you do that, your tenant, if you do a big jump like that, they're going to freak out. They're probably going to give 30 days notice. So that's why it's better to go, yeah, you screwed up. So spend the next 4 years slowly raising it. Don't just give it to them all at once. So you want to make sure that you want to make sure that you understand what kind of tax write-offs you're getting on that money, so that if you're getting benefit there, your operating expenses, your cash on your equity return. Is the equity that's in there, are you utilizing it correctly? Are you taking the equity in there, parlaying that, if you will, since we're in Reno, I'll use that term, parlaying that into other investment strategies so that they're duplicating themselves, not just sitting in an account waiting for the furnace to break. I mean, all of these things, they should be cumulative.
That's okay. I want to go down to this path, the cash on cash return, cash on equity return. And this is exactly what convinced my client to keep their rental. So take your equity that you have, take the rents that you're receiving, annualize those rents, divide it by the equity that you have sitting there, and then figure out what your rate of return is. It's really that simple. Now, in my client's case, Aaron, it was, I'm going to round it up, 6.7%. So it's going to be pretty hard for you to go find, at the new rent that he thinks he can get. I said, it's going to be pretty hard for you to go find a return, pretty steady, pretty guaranteed. It's almost 7%. It's like, I didn't look at it that way. And I find that's a real common mistake. People don't realize, but your point also, depending upon where you are, you may be maxed out and say, I don't want any more rentals. I don't want to leverage my money. But for someone that's, in the asset accumulation stage of their life, absolutely. You don't want to keep that equity sitting there. you get together with a professional like you run the numbers and say, okay, I can pull out whatever, $300,000. Here's what I can do with it. Maybe I'm going to parlay it into 1, 2, or 3 rentals, right? And you run the numbers, the mortgage, back out your expenses, see what you can make. That's how you start building true
And
net
there's no
worth.
tax consequence. That's the beauty of it. When you are borrowing against it, you're not pulling the money out of the property from the perspective of selling it, so that it's not a taxable event. That's how the rich stay richer
Okay.
and keep growing their assets.
Not last thing, but music's going to start here in a second. We don't have time to get into the 1031 exchange. We'll do again another show on that one. But Aaron, to your point, I want to wrap up on this one. Let's talk about the stepped up cost basis at the time of death, because this is where it, believe it or not, it needs to be one of your factors in your decision.
Yeah. So keep in mind that if you do a 1031 exchange or whatever, and you've deferred that over and over and over again, and you go ahead and do everything correctly as you're supposed to do it, and then you die, and then your kids inherit all of that. If you do it right, call John so you can get your stuff set up correctly. Then all of it gets wiped out, and whatever the current value of the property, it starts from then forward. So if, let's say that you had 150, 500,000, $1 million worth of taxes owed, it's now the big goose egg. Yeah. So that's the benefit about it. So for you to not take, so many people go, I want to set my kids up for success. I want to pass something down. I want to give them an inheritance. And maybe it's not financial, like millions of dollars in the bank. Maybe it's just that property.
Yeah, you got it. Great job, Aaron Clark. See everybody tomorrow. God bless.
Well, I don't remember what it used to be and if it's different from what it is. I think that, I mean, a lot of people that are going into it, they go from zero experience and knowledge in that world, and it's very scary and overwhelming to anyone in that world. Whereas I think if you have a pretty basic understanding of all that stuff, then I think it's way less intimidating. It's more like, because the instructor in the class always said, this class isn't to learn how to do real estate. This class is to learn how to pass a test. And that was what the whole thing was for. And nowadays, the amount of stuff that's out there right now, like, have you ever heard of Quizlets?
No.
So Quizlets is it's an app. You can download it on your phone, and you can look up a test for any subject on anything, or you can even upload your own stuff.
Really?
It'll create test questions for you, and then you just go in there. I mean, like, you know, if you're not to be too graphic, but if you're doing a bathroom session, you pull it out, you start running through it, and every time you get an answer correct, it categorizes it. If you get it wrong, it puts it in and gives you the answer. So it trains you to take a test. So like I did it for my, the first time I ever used it was my scuba test. When I did my scuba test, I used it for maybe like a half an hour one day and just kept running through the same, and it took all the questions from the scuba test. And not only did I learn it, but also I learned how to answer the questions for the test. And I aced the test 100%. It was like, this is the easiest test I've ever taken in my life. So now I use it for everything.
Yeah.
If I ever have to take a test, that's what I use it for.
Yeah.
So download Quizlet.
And it has Quizlet. It has it on everything. Huh?
Yeah. So you would just, anything that's like of any sort of popularity, which a real estate test would, just need to make sure it's the one for Nevada. Because studying in California means nothing, you know?
Right. No.
But that would be good.
What about getting a real estate broker's license, you know, after the 2 years? What advantage would there be?
I mean,
because I'm going to hang my license with you guys, but then what about getting a broker's license?
I mean, I've always talked to Corey about it because I was curious if it would like be some sort of an upgrade, if you will, to my credibility.
Right.
And he's always discouraged me because when you become a broker, then your level expectation of understanding and knowledge as well as liability increases exponentially.
Okay. So
it's actually better if you're doing, especially if you're not doing like actual business out there, like on the regular.
Right.
So if you're flipping homes or you're just trying to collect referrals or you're just, you know, doing simple stuff like that, it's better to not be a broker because of the liability aspect. Because I was looking at doing that like 10 years ago, and he was right. I thought, you know, I was like, is he just telling me? Not, you know, not that I expected him to just say that, but But yeah, it's true. When I looked in there, if you look the stuff that happens where like a salesperson does something, and most of it's innocent. I've made probably 5 major mistakes that were completely innocent, and they weren't even big mistakes. They were just big mistakes in the sense that it costed me something, money. And
Right.
so,
Right. Right.
where I've had to reimburse somebody for something or whatever. And they weren't even really mistakes. I just didn't do a good job of explaining something, or I didn't do a good job of covering my own
Mm-hmm.
ass kind of thing. And so
Right.
the liability behind that as a salesperson was exponentially less than if I was a broker.
Yes.
And so I would
Makes sense.
say,
Yeah.
yes, 2 years, great. But I would say like full time practicing, maybe 10 plus years, then I think that's the realm where you would go, okay, now it might be worth doing. But even like myself,
Got it.
I've been doing this since 99. And so for me, it's like
Wow.
I still learn stuff all the time, and I'm constantly asking Corey
Yeah.
questions about things that I don't deal with on a regular. Or even, I mean, if I haven't
Right.
done a probate in a year and a half and I get a new one and I'm like, shoot, I can't remember this part. I call him and he knows it.
Yes.
He's just that guy.
Right.
I'm the sales guy.
Right.
Like we're the
Right.
yin and the yang,
Yeah.
man. Like I can sell ice to Eskimo.
That's so cool. Yeah, that is
But
so
he
cool.
knows shit that no one else knows, and attorneys call him for advice,
No kidding.
so
Really?
absolutely.
Really? And he literally gets attorneys calling him for probate advice
Attorneys
and
call
stuff like
him
that,
all
right?
the time for real estate advice, some legal, and more of it is practicality, but still with legal lineage that they don't understand or they don't know how to approach it.
No kidding.
Because
And
you
how
can
does
only
he?
understand it if you're in it. And lawyers aren't in it. They just know
Okay.
the law. They don't understand the practical aspect of it. Like a
I see.
realtor, a realtor getting in trouble because they should have known that the septic wasn't the right size for the house. That was like a major lawsuit that everybody knows about here like 5 years ago.
Right. Right.
And so to an attorney, they're like, yeah, what an idiot realtor. They should have known that. But then Corey's like, well, explain how they would know that. Like, and in the law says they have to know this and they are supposed to disclose, but they don't know if what they're disclosing is correct or not. They're not experts. They never said they were so he's really good at like sort of exposing the
Okay.
weaknesses in that.
Almost having the attorney
He
mind, like
does.
manipulating the words
I
in a
think
sense.
he,
Isn't
I
that
mean,
something?
honestly, I think that was his
Yeah, I've
calling.
said that before too. Yeah.
Yeah.
Yeah. I told
Yeah.
him that too. Because he loves
He
that shit, right?
loves
He
it.
gets up at 3 in the
He
morning
hates
and
what I love, and I hate what he loves. Yeah.
no kidding.
So
What does he hate
he
the
hates
most?
the showing people property and disrupting his
Okay.
lifestyle. And I mean, of course, I don't like that too. I want to be free, but at the same time,
Yeah.
when I'm
Right.
actually doing it and I'm like walking through a house with somebody and
Right.
we're talking about their future and their life and investing and the house and all this stuff, I love that stuff.
Okay.
So, but he
Okay.
doesn't.
He likes more of the
He likes
strategy
he
stuff.
likes this. No, he likes the paperwork, and I like the conversation. I mean,
Does he
from
really?
if you were to like
I would have never thought.
simplify it, he's the
Yeah.
paperwork.
Yeah.
How do I write it in the perfect way to win? And like an attorney, and I'm like, how do
Yeah.
I help these people understand that I want to be in their lives for eternity from every generation selling in real
Wow.
estate by giving them
Yeah.
the best strategy so they all look at their lives 10 years from now going, if it wasn't for that conversation with Aaron, we would not be here today. That's where I'm at. So that's kind of the
Amazing.
difference.
Amazing.
Yeah.
Yeah.
So.
Yeah. Wow. Yeah, like you said, yin and yang.
Yeah.
Yeah, he always amazes me when he says, yeah, this attorney called and sought my advice on this. I'm like, damn, you got to know your
He
shit.
does.
That's the case.
Yeah.
Golly.
He's a genius, dude.
He just studies it all the
and
time.
I think from what I understand, one, he's very well respected in our world, and
Is he really?
and people, new agents have never heard of him because he's not out there like beating the streets like I am. So
Right.
he's not doing like shit tons of stuff, but when he's doing stuff, he's very well respected, and new agents get destroyed because he's so much better than them.
Really?
Yeah.
No
you can
kidding.
tell. So.
Wow. Yeah, I love it. Does he get a kick
I
out
think
of that?
so. I don't
Smashing
even know if
everybody's.
he realizes it, to be
Yeah.
honest with you. So.
Yeah. So
Mhm.
humble.
Yeah.
Crazy. Good stuff. All right.
Cool.
Perfect.
All right, man.
All right, buddy.
See you next week.
Thank you, man.
All right,
Always
later.
fun with you. See you, buddy. Bye.